Welcome to TradeTheMBA.com. This is John. This report is for the 21st, and this fall is about to begin. Well, we got the Fed coming out and basically doing what we thought they would do, which would be to say that they're still cautious. But at the end of the day, with what we've been seeing from oil, there was zero chance they were going to do anything but, at a minimum, hold. The worst thing they could have done would have been to further raise rates. But the MBI White lead clear on this. It started with the peak that began right there. We had a brief moment where bulls were trying to overtake the situation, but we saw the rejection a few days back of DOC cyan to green. It's never positive. And from that standpoint, it was just a matter of waiting for the eventual slow build. And nothing was catastrophic within the early signals. We could continue to see that there was a potential for just holding relatively reasonable. We've maintained this middle range here from the previous breakout spike that had taken place. But with the NBI white lead, it was just a matter of waiting for a move towards that 0%, and still haven't moved all the way back to the positive extreme from back over here, and that's all the way down to 42.74. So it's still eventually where things are going to go. First range would be the 43.99 range, simply because as long as that NBI white leads with the magenta having faded, the expectation is a move to the zero, particularly when you're under the 50%. If we were up at the 100%, it would have been a projection to the 50%. That's the way that functions, and we go over it a lot. The interesting thing about it was we said the NASDAQ was weaker uh, from its general read. It never had DOC crossover from before, and shakeout was continuing to move negative. So the fact that it broke even below the 23%, not a surprise. It was undergoing a bit more. And the reality is that the Fed, while stopping from raising rates, says that they're not planning any cuts. Now, the question will become when and if we start to see the GDP numbers move soft. And the Fed's expectation is that the economy is going to continue to grow and things are going to be fine. Um, I would disagree, but they've been doing okay at managing the excess and the raising of rates. I think they got a little too aggressive too fast, but um, they really wanted to suck out that liquidity that existed. I think that that's been wiped out. They've normalized rates to a point where they have ability to do things in the future and can claim that they, have normalized things after, a decade plus from the 2008 breakdown. And from a market reaction, pretty modest, I think. Could be significantly worse, relatively speaking, to where the valuation is, given where rates are. So when we look at treasuries here from a TLT standpoint, we're at the higher end, and with no expectation that the Fed is going to be cut. There's no reason why this won't stay relatively in this area. And it simply becomes a question then of watching oil. If oil fades back, I think Treasury stay at the low end. That puts pressure on the market even further because at that point, you're better off taking the safety of Treasuries if you're not having an expectation of spike in inflation. Unfortunately, with these numbers, and you can see some of the analysts have already targeted, $100 a barrel oil, and um, that would put you in an extremely negative situation, and then you would expect a significant market retrace. Right now, you're looking at just a soft slide. The difficulty for that is that with the Fed holding, where it is, the ECB cannot even match in any way, and it puts a lot of downside pressure. They keep still trying to defend this at that 106 range because we know that as it gets below this area, it's going to be really hard to control capital flight from Europe, and if the U.S. economy numbers start to fade more, we already know that the EU has been in recession situation. That would exacerbate that move, which would also put pressure on the S&P because exchange rate derivatives that they get help a lot of S&P companies. So that would be problematic as well. Gold had started its move back up. retrace some of that, not surprising, within a market sell-off, and it's still been representing the week. Does it make sense given what we're seeing from oil in that? Not a whole lot. Should be rallying, but it did not suffer anything near what the market relative move was. You would also think that Bitcoin and other cryptos would improve, but again, looking at that same MBI white spike, sure they've got the magenta over yellow, which is enough to hold it up. And even from the DOC standpoint, those are all negatives at this particular stage. So that they're actually sustaining themselves is relative positive. The fact is, if they can withstand this negative short pressure that's pretty much built into what these readings are, um, means a much later and greater breakout when it does take place. So here it was from the 50K standpoint. Pretty clear they started out early with the nice pump. We had the MBI spike, but magenta was still over. It wasn't until the cross that things turned red. And then from there, it was just straight down. And look at that shakeout, minus 32. That's carnage, is what you would refer to it. Literally, just no one interested in the buy side on that one at that particular point, and for a relatively good reason. If we look at it from an intraday standpoint, at the slow build up, we started to create this series of positive extremes. I went ahead and took that short up there at the peak, was looking for that range, and as we kept having MBI spikes added to that, then it was just a matter of waiting. And as we moved across, you continue to have small attempted spikes, but then we were only getting back to the 50% range and getting sell crossovers back over there. Makes it pretty easy. The 4502 became the stop category up at that point once the breakdown, and then it was just a matter of if the decision for the Fed goes your way, golden. And if it was counter and the Fed was going to soften, then you get stopped out. But in this particular case, that was not a concern, and things just faded for the remainder of the day. And then even here in post-market, no real excitement. We're starting to catch a little bit of a bid here in the very early European trade, but it's going to take a lot to recover from that kind of softness, because what's the impetus for jumping back in at this particular stage? Not a whole lot, except for those who think they're going to find value or a deal in that. But it becomes a little problematic until you know exactly where the state of the economy is and how much those oil prices have really damaged GDP growth. And I think they always underestimate the impact of that. But we'll see. For now, the readings, I think, are pretty clean with that. That doesn't mean that when you get this kind of move that you're not going to get some pullback in there, because you'll get short covering in between. But again, first zero target at the 43.99, and then below that is still going to be the positive extreme fill from the daily going all the way back to June. So that's the long and the short of it for now. As always, don't trade well. Look for me on Skype chat.